There's a good reason I've never sold a single XRP in over 7 years of holding it. Actually, there are many reasons, but let me break down a few core ones for you real quick. Let's skip the fluff and dive straight into the foundational reasons behind my decision to hold strong. Now, this isn't an exhaustive list, but these are some of the big ones. And don't get me wrong, if XRP's price skyrockets to a point where it's too tempting to resist, you bet I'll sell. Ideally, I'd cash out completely and then scoop up more during the next bear market.
Tired of fake gurus who claim to be expert traders but never trade live? I trade live on the second largest crypto exchange, where everything is transparent and results can't be faked. For over 440 days, I've consistently closed every month in profit. In the last 90 days alone, my followers have seen over 70% profit with only 4% drawdown. Verified results, not empty claims. Want to see my verified stats? Click the first link in my profile and start copying my trades for free today.
That's the dream scenario, right? Hold, sell high, and reaccumulate when the market cools off. Sounds like a solid plan to me. At its core, I've never given up on crypto because I believe in its future. The crypto asset class is only going to grow, and that's because people truly value what cryptocurrencies bring to the table. Once I realized that, it became clear to me crypto isn't going anywhere. I figured that out pretty early on. This permanence means certain assets we see today will thrive long term. When I connected the dots and saw how crypto enables business models that couldn't exist without its unique attributes and utility, it hit me, my aha moment. That's when I knew this space is here to stay. For me, that realization began with XRP. The moment I saw what XRP could do, I knew it was special. That sparked a deep dive into XRP, and I've been following its journey ever since. Monitoring the ecosystem over time has only reinforced my belief. I've stuck with it because XRP isn't just hype, it's genuinely useful. And that utility is a big reason why I'll never quit. I've never given up on XRP because it has real-world utility. I genuinely believe people don't abandon technology that works and adds value, especially something as transformative as this. Think about it. Can you imagine people tossing out something like the internet? Oh, that amazing tool that changed everything? Yeah, let's just stop using it. That's not how humans operate. When technology improves lives, adoption is inevitable. That's why I firmly believe XRP is here to stay for the long haul. For over a decade, we've been moving in one clear direction, towards greater adoption, and we're only picking up speed. Set price aside for a moment. Let's talk about actual use cases and the growing ecosystem. The utility is undeniable, and it's driving real-world adoption. Also, I've never let market volatility scare me into making bad decisions. Riding the ups and downs without panic is key, because the data shows that basing buy and sell moves purely on volatility is a recipe for regret. I want to dive deeper into that in this video. Now let me introduce you to Frecky, an XRP community legend and true OG of the crypto space. Frecky, aka Frecky Crypto OG, has been around the financial world for decades and joined the crypto scene back in 2011, basically the dawn of it all. He's seen it all, and his insights are always worth paying attention to. So let's explore volatility, adoption, and why it all points toward one thing: XRP's bright future. He really knows his stuff, and he recently dropped some slides on X, tagged me, and I checked them out. My reaction? Yes, this is gold, and everyone needs to hear it. Seriously, this is the kind of insight that, if you let it sink in, can change how you think about money. It'll stop you from making rash, emotional decisions with your hard-earned cash, whether it's investments in XRP or anything else. Now, I'm not here to tell you to buy, sell, or hold. That's your call. But I promise you, what I'm about to share in this video could keep you from panicking during market volatility. Sure, if you've got a legit reason to sell, like a personal emergency where you need cash right away, I get it. Life happens. Or maybe you find out there's a major flaw in the code of some crypto you own. Yeah, I'd understand jumping ship before it sinks to zero. That said, even then, things aren't always what they seem. What if the flaw turns out to be fixable, the panic fades, and everything stabilizes? There's always risk, no matter what. But I get it. Sometimes selling makes sense. Like when people dumped XRP after the SEC sued Ripple. I don't call them weak hands. That was a tough situation, and I totally understand why they bailed. They were victims of bad circumstances. Me? I held strong through all of it. And honestly, when it comes to XRP, I'm in it for the long haul, even if it goes to zero. I've said it before, and I'll say it again. That's my deal. I'm riding this thing no matter what happens. Now, Let's dive into the first slide Frecky shared. It's titled, Missing the Best Days in the Market. And here's the gist. Investing in the stock market can feel like a roller coaster, tempting some to cash out to avoid losses. But predicting good and bad days is impossible. The chart shows just how costly it can be to miss even a handful of the best days. Over time, sticking with your plan pays off. Just to clarify, this data focuses on the S&P 500 over a 45-year period. I hear you loud and clear. This concept definitely fits the world of crypto. Take XRP, for example. It's been around for over 10 years. And if you look at its best performing days, they're just a tiny fraction of that time. Miss out on those, and you've missed the boat. The same goes for Bitcoin and other established coins that have stood the test of time. I'm not saying newer coins won't eventually show similar patterns, but if a coin's only been around for a few months, there's just not enough data to draw meaningful conclusions. That's the key point here. Track record matters. Now, let's zoom out and talk about the stock market for a second, because the lessons there totally apply to crypto, XRP included. If you think you're clever enough to time the market, selling because you think prices will drop and planning to buy back in cheaper, well, get ready for a harsh reality check. History shows that those who try to outsmart the market often lose big. Panic leads to poor decisions, and those who act impulsively, they get wrecked hard. Want to know who wins in the end? People like me. Steady, patient investors who buy and hold without trying to game the system. Consistency beats cleverness every time. I stick to the simplest investment strategy out there. I buy and then I wait. That's it. No overthinking, no frantic moves, just patience. And guess what? People like me with the most boring investment approach on earth outperform the ones constantly doing things. Yes, even market traders. Let me show you why. On your screen is the growth of $10,000 invested in the S&P 500 index from December 31st, 1979 to December 31st, 1980, 2024. That's 45 years or 16,425 days. For anyone who's counting, and no, I didn't bother accounting for leap years because it doesn't matter. If you stayed invested that entire time, your $10,000 would have grown to a whopping $1,708,147. Not too shabby, right? Especially considering it's not crypto or some moonshot gamble. That's just the power of compounding in a mature, reliable asset class. Now here's where it gets interesting. What if you missed the 5 best days over those 45 years? Just 5 days out of 16,425. Surely that wouldn't make a huge difference, right? Wrong. Missing those 5 days slashes your returns down to $1,059,083. That's a difference of nearly $650,000. Painful, right? And yet, people think they can time the market and somehow avoid missing those critical days. Good luck with that. Seriously, good luck. You're going to mess it up. You're going to screw it up. That's why stubborn investors like me, who simply stay in the game, come out ahead every single time. What about missing the best 10 days? Instead of earning $1.7 million, you'd end up with just $762,823. Let that sink in. Missing 10 days out of 16,425 cuts your return by more than half. And somehow, people still believe they can outsmart the market, jumping in and out like they're some kind of investing wizard. Spoiler, they're not. They lose. They underperform. Meanwhile, the ones who stay put, we win. Now let's take it further. What if you missed the best 30 days? Just 30 days out of more than 16,000. I'll let that thought stew for a moment. Imagine this. It's just 1 month out of 45 years. Not a big deal, right? Wrong. If you missed just that 1 month, instead of earning $1.75 million, you'd be left with only $274,133. Ouch, right? But it gets worse. What happens if you miss the best 50 days out of 16,425 days across 45 years? That's just 50 days. Sounds minor. Well, instead of $1.7 million, you'd end up with a measly $120,110. See the problem? This is exactly how people get burned in markets like crypto, XRP holders included. I remember when I first dove into crypto back in 2017, I was soaking up every bit of content I could find. YouTube, blogs, you name it. There was this one guy though, I'll never forget. He filmed a video, maybe at a playground with his kid, talking about how he'd just sold his XRP. He'd been holding for ages, but he'd had enough. It wasn't moving. Too risky. Too much missed opportunity elsewhere. so he dumped it and went for what he thought would moon. I remember watching, thinking, man, I don't know about this decision, but hey, you do you. No joke, just days later, XRP absolutely exploded. It was December 2017, and XRP took off on the biggest bull run in its history. That guy? Well, he knew better, didn't he? Sucks to suck. Look, you all can do whatever you want, but I'm telling you, this is how people wreck themselves. Take a look at this slide from Frecky. It's called Staying the Course. Here's the deal. Investors see short-term volatility as the villain. When markets get shaky, people panic, take their money out, and wait on the sidelines. Feels safe, right? But that safe move creates even bigger problems. First, when do you get back in? You've got to nail 2 perfect calls: when to exit and when to re-enter. Good luck with that. Second, if you're out during a rebound, you miss that growth entirely. And third, it's not just the rebound you miss, it's the compounding growth that comes after. That's right, folks. Compound interest, the 8th wonder of the world, disappears for you if you sit out. And guess what? You don't get to make that money back. Ever. But hey, I'm sure you know better than the market, right? You're the genius who can outsmart the system. Just remember, when you're sitting on the sidelines, the market isn't waiting for you. It's moving on without you. When faced with market turbulence, you can either be the genius everyone turns to or the one frantically panicking. But here's the truth. The smarter move is to pause, review your plan with a financial professional, and determine if any action is truly necessary. It satisfies that itch to do something while keeping your emotions in check. Seriously, talk to your financial advisor. Think of them as part money expert, part therapist. Someone to calm you down while your net worth takes a roller coaster ride. Freaking out doesn't help. If you really look at the data, the fear often doesn't make sense. Take the stock market. Being scared of its collapse is basically betting on the end of the US economy. If that happens, the market is the least of your worries. But if the country isn't going under, and I'm betting on that, it's just a matter of time before things recover. Remember 2008 to 2009? People were convinced they'd never retire. Sure, timing was tough for those retiring immediately, but for most, that crash became an incredible opportunity. Those who could keep earning and investing saw massive gains later. Today's stock market is way above 2009 levels, even though back then, it felt like the world was ending. Now, take that same panic and amplify it for crypto. Prices drop, and suddenly everyone thinks it's over. But here's the thing. Volatility alone doesn't predict whether a cryptocurrency will survive long term. There's so much more to assess. Some bets will fail. I might even be wrong about some coins. Maybe XRP goes to zero. Unlikely, but possible. Still, I believe in holding a diverse range of crypto assets for the long haul. Sure, some coins might flop, but the winners could outperform so dramatically that the losses won't matter. It's all about playing the long game. So yeah, I don't sweat it. Long-term exposure is the strategy. Some coins will tank, and that's okay. The ones that succeed, they'll make it all worth it. That's why I stick to this approach, even when it feels chaotic. Remember, big picture, long-term mindset. Volatility isn't anything new. Markets have always had their ups and downs. Since 1980, the S&P 500 has seen average intra-year pullbacks of around 14%, yet history shows that patience often pays off. Those who stay the course are usually rewarded, and guess what? That's exactly what I've done with XRP. Have I sold? Nope. Have I been rewarded? Absolutely. My average buy-in for XRP was 25 cents. In January, it skyrocketed to $3.39. Sure, it's pulled back since, but this feels like price discovery. I'm holding strong, and my net worth is way better for it. Now check this out. This chart is a goldmine of perspective. The yellow bars show intra-year dips, while the blue bars represent the calendar year returns. Notice a pattern? Even in years like 1994, where the market finished down, the majority of years ended up in the green despite substantial dips. This is why I wanted to compare it to crypto. These sharp pullbacks? Totally normal, especially with Bitcoin and the entire crypto space. What's exciting is seeing XRP's strength amid all this. It's a wild ride, but these dips don't mean the year won't finish strong. So, here's the thing. If the bears are right, which, let me be clear, I seriously doubt, but if they're right, and we're slipping into bear market territory, and the cycle highs are already behind us, okay? Big deal. Who cares? Markets rebound. Always have, always will. I honestly don't give a damn. There's no magic trick to making money in crypto, no hidden shortcut. It's simple. You diversify, hold your positions, and wait. That's it. The winners, They're the ones who have patience. The losers, impatient, every single one of them. Crypto isn't some overnight get-rich-quick scheme. Sure, compared to traditional stocks it feels fast, but it's not like you can just buy some meme coin and wake up a billionaire. That's fantasy. Outliers exist, sure, but they're the rarest of rare. Almost no one has that story, so why aim for that? It's not realistic. But here's the good news. Life-changing wealth in crypto, that's real. It's out there. You can do it, but only if you're willing to wait. Because truth is, no one knows how long it'll take. That's the game. Now take a look at this. A chart showing the growth of $10,000 in the S&P 500 since 1970. Decades of ups, downs, and everything in between. It's a testament to the market's resilience through crises and major events. And trust me, some of these events felt like the apocalypse at the time. Boston Marathon bombing, first COVID-19 case in the US Silicon Valley Bank collapse, just to name a few. Go back further and it's the same story. Massive dips, widespread panic. Was it the end of the world? No, of course not. It was just retail speculators losing their minds because they didn't have the data or discipline to keep their emotions in check. That's the truth. The markets, they bounce back. They always do. Calm down, seriously. Just take a deep breath and focus. Do whatever works for you. I'm not here to tell you what's best. All I'm saying is, whatever decision you make, use the data, think critically, and let logic guide you. Buying, selling, holding, it's your call. I don't have a crystal ball, but I know you're smart enough to figure this out for yourself. And hey, just to be clear, I'm not saying you're wrong or foolish if you've dabbled in this stuff. We've all been there. What I'm saying is, if you don't want to end up like those retail speculators losing money left and right, you've got to learn from your choices. That's how you improve. The data doesn't lie. This is what's most likely to work. That's why I'm pointing it out. Props to Frecky for sharing those insights earlier, by the way. Let's revisit that first chart he posted. It's back on your screen. His message? Time to blow your mind. And he's so right. No one can predict the best days in the market. The move is to build a solid position, hold steady, and ride the ups and downs. In crypto, think long-term. Multi-year swings, 4-year cycles, whatever works. Or just lock it in and hold tight. That's the play. Frecky gets it, though most people don't. Even with this data, controlling emotions when markets dip is a whole other beast. That's the real challenge. I think a lot of times people end up selling because they lack knowledge. It makes sense. If you don't fully understand why something is happening or might happen, panic sets in. That's human nature. On Frecky's second slide, they nailed it. Most people don't know this, so I figured I'd share. Usually only institutional players are aware. Here's some good info on volatility. The chart showed something simple but powerful. How intra-year declines, orange, compared to annual returns, if held, blue, from 1980 onward. And it's eye-opening. Most people don't realize this, not because it's some big secret, but because it's just not common knowledge. Here's the thing. Making investing mistakes doesn't mean you're bad or stupid. It's just human behavior. But if you agree that some of those mistakes aren't ideal, wouldn't you want to know more so you're less likely to make them? For me, it's an easy yes. Now, on the third slide, Frecky wrote, "Enjoy this one. The market has seen just about every flavor of what media and retail get emotional about. You'll be okay." That hit hard. It also showed why diversification matters. When the S&P was flat, emerging markets soared 400%. And international markets gained 200%. That's why you don't put all your eggs in one basket. It's a good reminder not to let emotions rule your decisions and to balance your portfolio, not just for protection, but for growth. What do you think? I hope this sparked some thoughts. Let me know. I'll wrap it up here. Oh, and one last thing. I'm not a financial advisor. Don't buy or sell because of what I say or write. Seriously, that would be a terrible idea.